that psychology is almost like above everything. Like you can kind of lump in risk management with psychology, but I think those two aspects are the most important in the long run, are the most important inputs.
Hello and welcome to a new episode of Conversations with Leaders, where you can get valuable insights from successful investors and financial leaders worldwide. My name is Sam North, a market analyst at eToro, and I'm happy to be your host today. Being a successful trader and investor takes time to master. Knowledge, experience, psychology, and consistency are just some of the key attributes to help on this journey. Our guest today has it all, and I cannot wait to get their insight. We are joined by Brent Donnelly, currently president of Spectra Markets, who has traded since the mid-90s, wrote about macro for almost 20 years, and has recently written 2 books, The Art of Currency Trading and Alpha Trader. As well as a trader and portfolio manager, he has spent time as a market maker and senior manager at some of the top banks in foreign exchange. You name it, his words have been published by that organization, from Bloomberg to the Wall Street Journal and the Financial Times. Brent, welcome to Conversation with Leaders. How are you?
Hey, Sam. Thanks. Wow, what an intro. I want to meet this guy, whoever he is. Sounds interesting.
Yeah, it sounds like an Oscar nomination there, doesn't it? But yeah, what a career.
Quite the intro. That's one of the best intros I've ever got.
Yeah, fantastic. Well, I'm looking forward to it, and I'm sure our users will as well. So we've planned to sort of go through different sections. Views on the market right now will be where we first go to. And how are you seeing things at the moment? And how do you gather information to create a bias or a view?
Sure. So let me just clarify a couple of things for the viewers. So I'm a trader. Generally, my time horizon is not an investing time horizon. It's more like 1 week to 1 month. But what I write about and what I look at is much bigger picture. So my philosophy generally is if you look at all the prices in the world and you say, okay, that's the current equilibrium, that's the sum of all the known information and all the flows that have gone on, and that's kind of where we are. I think you have to have a good understanding of that before you can forecast where you're going. So even though my time horizon's shorter, what I'm trying to do is like understand the macro picture and like in FX, which is my main thing, the microstructure and the flows and everything. And then that way, when you have a really good understanding of where you are, then when new information comes in, you can react, more quickly and hopefully more intelligently than others as price kind of tries to find its new happy place. So right now it's really interesting because the people like forecasters and researchers and stuff love to throw around like uncertainty is very high. And like, yeah, dude, it's always a lot of uncertainty, uncertainty is always high. But I think what's different about this year is that the range of outcomes is much wider than normal. So like going into 2022, Fed was tightening into a bubble, and it was a question of like, what is that going to mean for asset prices? And it was kind of clear like what the narrative was. We knew what the Fed was going to do. It would all kind of been, they were going to be on autopilot for a while. And then obviously they accelerated. But going into 2022, it was kind of like somewhat clear what was going on. Now, so I try to think of the market always in probabilistic terms. So I'll never say like the market's definitely going to do this or the market's definitely going to do that. Like, I don't think that's a healthy approach. I think what you want to do is have a set of probabilities in your mind and then assess how those probabilities match what's priced in, and then, look for divergences. So sometimes you'll hear the cliche of like the market's always right or the price is always right. I mean, I absolutely disagree with that. Markets are efficient most of the time, but what you're looking for is times when you disagree with the market, yeah. Right? And you say the market's wrong because of this, this, and this. So right now, in the spirit of being probabilistic, what I'm trying to do is really assess where the market is between the 5 main scenarios, which I have in my mind, which is, all the way from like hard recession would be obviously the worst case, which was a much more expected part of the distribution like a month ago or 2 months ago.
Yeah.
And then, so like I would call that like crash landing. Then you have hard landing, and then recession light is kind of like what we experienced a bit in 2022, where like real growth is negative, but nominal growth is okay, kind of like, muddling through. And then you have soft landing. And then recently probabilities have been going more towards no landing, which is something where like at the end of this year, unemployment's still at 3.4, Fed's still hiking. And so what I'm generally doing is trying to like toggle between what is the market thinking, what's the data saying, and then what are the good trades that you can put on in response. So like particularly right now, I'm very bullish dollar yen, specifically because we're moving to a more, or like a less scary economic environment, like ISM obviously and payrolls being the two main things. But I think in general, you saw kind of like this absolute low in December in terms of sentiment, spending, and everything all around the world. And now we're seeing a rebound from that. And when sentiment was bad, really the hard data never got that bad, other than retail sales in many countries. The hard data held in, especially obviously labor market held in very well in most countries, including Canada and the US. So now you have a scenario where people were buying like dollar yen downside for a hawkish BOJ and for US recession. And now it looks like Amami is probably in. I trust the leaks in Japan. Obviously that could be wrong, but we'll find out in a couple of days. But then really the key is that yields are shooting way higher, right? So dollar yen, 99 days out of 100 is a trade based on US yields, in my opinion, like all the way back to like 2003. That was always the best framework for dollar yen. So of course, if a very hawkish governor comes in and they rip the Band-Aid off, then dollar yen will go down because that's at the margin, bullish for the yen. But what it looks like to me is the more dovish candidate is looking more likely, just as US yields have kind of like, I wouldn't say moonshot, but US yields have gone a lot higher. So to me, dollar yen looks very low. And then you can kind of like overlay on top of that, like what has positioning been? And generally in 2023, there's been a very strong bias to be short dollars. So I feel like there's enough pain, specifically dollar yen, but all across the board, that a dollar rally is kind of like the path of least resistance now that people have established dollar shorts. And the thesis isn't playing out too well for them specifically because of what US 2-year and 10-year yields are doing. So I think the dollar does well. And then really like the data is so important. I honestly feel like, yeah, we obviously trade the Fed and it's important like on the day of, but like how many times has Powell come out dovish, everything rips, and then it just craps out 2 days later because the data is strong. So to me, like as anyone other than a day trader, I just think that the data is much, much more important than what the Fed's saying. And there's times when that's not true, right? Like if the Fed's in control of the narrative and they're going to do what they're going to do, then it does matter what the Fed's saying. But really what they're doing is they're more just reacting to the reality on the ground. So if the reality on the ground says like, whoops, inflation's bouncing and jobs market's strong, the Fed's just going to be hawkish and they'll probably be hiking 50 in June or 25 in May, 25 in June. So I feel like fading the Fed and going with the data also is more of like a good short-term strategy now. And that's not always the case.
No, for sure. I mean, it's really interesting just hearing you talk about the dollar yen and how you sort of, come up with a potential strategy for that and how you could be reactionary to the other side of it, that if we do get a hawkish, BOJ governor. Just quickly on sort of currency trading, do you have a favorite pair, or is it a case of you'll trade what's the best opportunity at the moment for you? Is it, you don't set out and say, okay, euro dollar is my trade and I'll just go that way?
No, generally I cycle between them. I mean, I would say like in my career, I've done more dollar yen and dollar Canada, simply because I like to trade a lot of correlation, and dollar yen is the most reliable correlation. It just is almost always correlated to yields, except, there's exceptions. And then I'm Canadian, so dollar Canada is always kind of an interest just because like I've obviously followed it my whole life. But I think one thing that I don't like when I manage traders, and they'll say like, "Oh, I'm losing money in Eurodollar every day. I'm taking it off the screen." I think that's a really bad idea. Like you should be switching currencies based on whatever the regime is. So, if China's in play, then Aussie's going to be a more useful trade, whether you're going up or down. That as an example, or if EM's in play, then I'll trade a lot more dollar max. But if EM's kind of just doing, nobody cares about EM. Like 2022 was one of the rare times when people were much more into G10 than EM.
Yeah.
So I wouldn't really be bothering with dollar max at that time. I think you want to be trading the things that are in play. I mean, it's just like stocks, right? Like if you're day trading stocks or whatever, short-term trading stocks, you're running screens for what's moving, what has high volume. You don't want to be trading things that no one else is trading, because it's just a lot harder to make money, because they generally won't move as much. They won't be as liquid, and there's just not as much point.
Yeah, for sure. You don't want to limit yourself in that regards. Let's talk then about
Right.
the remainder of the year. And I realize you don't have a crystal ball unless there's one hiding behind you there. But what do you think drivers for the remainder of the year? Have you got like a checklist or a top 3 out there? Is there anything you're really thinking, okay, for the remainder of the 10 months or so that we have left, these are the important factors?
Yeah, I mean, there's factors or like checkpoints, like you say, on the global macro side, and then of course there's individual ones for different countries. Like, so I'll go back to the macro side, but an example of a more idiosyncratic one would be consumer debt is very high in Canada, but the jobs market has been strong, real estate's been strong, and so you can have as much debt as you want if you have a job. That's kind of like generally how it works. Is you can service the minimum payment and make your mortgage payment. But when people start losing their jobs, that's when the house of cards comes down. Mm-hmm. So for Canada specifically, my signpost is basically the labor market. And like, I'm biased to be short Canada, but I'm not really going to get that excited about it till the labor market turns, because, like I said, there's a lot of positive things like immigration in Canada. And if the jobs market's strong, people will just keep making the minimum payments, and, the Wile E. Coyote will never fall from the sky. In the bigger picture, I mean, the Fed's obviously important, but like I said, it's really more about inflation. So what Powell's been pounding the table on is like disinflation has begun. And yeah, okay, that's true. But first of all, we knew that months ago because of base effects and stuff. But the question isn't like, have we peaked? Because I think it's almost unanimous from almost everyone that yes, inflation has peaked in the United States. The question is, where's the floor? So if the floor is 1.5, 2, that's a completely different story than if the floor is at 3.6 and then we start bouncing off of 3.6. So I think inflation is really the key to the Fed. And what I'm going to be looking for is, where does it stabilize? And I mean, one thing that I think is bad that people do is they start looking at more recent data, like 3-month. People are looking at 3-month annualized CPI, and like there's enough volatility in it that doesn't mean very much to me. And if you look at January, that number is going to be like 0.5 or something. So I think you have to really make some assessment over like the next 3 to 6 months. Is inflation bottoming, or is it going to just keep on going to 2%? Because like the tips market and all that is pricing basically back to target of 2% by the end of this year, or somewhere around there. So if that doesn't happen, that's like a huge story. And then the other story that I think is, so US inflation is number one. And number two is China reopening, I think, because you have all the pieces in place there for like a reflationary, good news, good for global growth, good for commodities, all that. But all we're doing now is assuming all that, right? That it's going to work out that way. And the parallel that everyone's making is like the US, when the US reopened. But when the US reopened, they were throwing $5 trillion around into people's pockets, like directly into people's bank accounts, right? So that was like a turbo crazy reflation trade. The question, which like I think it's reasonable to assume, growth should pick up in China and all that, but maybe people come out shell shocked and look at their real estate values, and China's a lot more levered to real estate, and real estate has collapsed there, gone down a lot. So it's not the same as the US where everyone felt rich and everyone was getting money jammed in their bank accounts. So I think the signpost there is like Q2 activity in China, because the weather's still not great. New Year just happened. So in Q2, like, does spending meaningfully pick up? Do local governments and does everyone start lending and spending? Because I think it's still up for grabs whether that happens or not. And if it doesn't, then that's going to be bad. And then I guess the other question that's like just something that you can't really figure out other than just by watching equities is like, how long can equities survive higher rates? Because there's two components to equity and like the relationship between equities and rates. One is that interest rate volatility on the top side is always bad for equities. Like, it's just scary and you don't know where it's going to stop. But then now yields are going up, but volatility is pretty low. So you could get an environment where yields go up and, you know, equities finish the year at S&P finishes at 4,400 or something like that, where you just have like the immaculate rebound of consumption stays okay and everything's happy. I mean, I'm skeptical of that, but it's possible. And so the ability of equities and earnings to withstand higher rates, I guess, is really the question, because the lags are, you know, long and variable, as they say. So at what point do you get companies that unable to refinance and all that? And right now, like, I mean, credit spreads are at the tights, right? So you can't just stay bearish stocks all the time. You know, there's always going to be a reason to be bearish stocks in, you know, every day of every year, there's always a reason. So I think I want to be careful with that this year, because I'm biased to stocks going down, but I think there's plenty of scenarios where like we skate through. And I think a good analog for that would be like 2006, where you had the yield curve inverted, housing looked sketchy. I mean, a lot of things looked really bad in 06, but we kind of skated through for another almost 2 years, right? And so being short from 2006 to 2008, I mean, it cost people their jobs, because, you know, you can't be bearish for that long and be wrong for that long unless it's your own money, you know. So I think that's the third thing that I'm watching is just, can equities remain resilient in the face of stronger growth? So like, for example, yesterday we had yields up, equities up, and that's an interesting day, but I mean, it's only one day.
Yeah. Yeah, it'd be a very interesting time on Twitter, I think, if the S&P 500 got anywhere near that all-time high again this year. Just on...
Yeah, actually, you make a good point there, like implicitly, that you got to be careful what you read and what the biases are of what you read. You know, like negativity bias is a thing in all media, but on Twitter, people now understand, like, the algorithm rewards you if you're bearish, and it rewards you if you talk extreme targets and all that kind of stuff. So because the incentives are misaligned on Twitter, there's not really like a huge incentive to just put a reasonable, you know, hey, this is my base case, but, you know, I'm a probabilistic guy and this is what I think might happen. Like that gets 38 views. And if you say like stocks are going to crash, man, you get 10,000 views. So I think it's important to know like the bias and the incentives. Same thing when you're reading strategists, right? Like if you're reading someone that's been bearish for 10 years and like they are always bearish, then that's probably not a very useful analysis to read, even though it's fun to read. You know, there's probably a lot of confirmation bias in that person, and you're probably not going to get too much value out of it. So I think that's something that I learned later in life, was to be like a healthy skeptic when you're reading stuff and think about like, okay, who wrote this? What are their incentives? And like, sometimes people are just intentionally promoting, you know, things that they probably don't even really believe just because they know that's going to get clicks. Whether it's Bloomberg or Twitter or whatever, I think it's important to kind of filter for, okay, is this person always negative? Is this person like being outrageous on purpose? That kind of thing. So I try to do that and then narrow down to like, okay, these are strategists that I know are somewhat flexible. They have their worldview, but they're willing to incorporate new information. And then one by one, you weed out the ones that aren't like that. And then you have a good core of people to read.
No, for sure. It completely makes sense. I think there was a tweet yesterday from Michael Burry, wasn't there, saying this time it's different. And the week before that, he said one word, which was sell. And you kind of get the impression where he's coming from each time. And that's one end of the spectrum. And then on the other, I think Jim Cramer was like, this is a reminder, it's a bull market. So, yeah.
Yeah, exactly. Right.
It's
And
fun.
we tend to make heroes out of these people that have correctly predicted like one event. But they tend to very often, there's a lot of luck in trading, especially on short time horizons. So you look at like John Paulson, who correctly called the crash of '08. He probably made $2 billion from, like, he took his 1 billion to 3 billion. And then based on that, he got inflows up to 30 billion, and then he lost 15 of those. Right. So like net, people think of him as a hero for catching the crash, but
Yeah.
he's cost his investors a lot of money.
Yeah, big time. Let's take a little.
And I'm not picking on him. I mean, I don't know the guy. I'm just saying,
No, yeah.
I think we tend to elevate people that make hero calls. But like, if anyone out there plays poker, making a hero call doesn't make you smart sometimes. Sometimes it just means you got lucky. You were at the right place at the right time, right?
Yeah, for sure, for sure. Let's take a little step down to the sort of psychology, risk management part of trading and investing.
Sure.
A lot of people will know that trading psychology is important, but probably don't really know what it is. So for you, what would you say it is, and why is it important, and how do you think people can actually improve it, to improve their results with it?
Right. Yeah. So it's such a broad field, and I've always found it very interesting. I remember reading, when I first started trading, reading a book by Mark Douglas. And there's kind of like a bit in there basically saying some people will lose money on purpose because they don't feel like they deserve the money. Like if your parents were tradespeople who, did real work in the real world, or they were teachers or whatever, some kind of thing that's like high value add to society, then maybe when you make money as a trader, you feel like you don't deserve it. So you like self-sabotage or whatever. And I remember reading that and thinking like, dude, what are you talking about? This is nonsense. Like, this is like crazy psycho babble or whatever. And then as time goes on, I actually realized, like, and I'm not saying that specific thing, but there's many psychological elements. I believe much more in the psychological elements of, trading because you're bored, and then you just are sitting there, there's no good trades, and you start trading because you're bored. And then it can become borderline like a gambling type situation, especially if you have a small account and you're trying to make returns that are not realistic relative to the size of your account. So anyways, to answer your question, so I was just trying to give that background because I kind of felt like it was seemed a bit self-helpy, some of this trading psychology when I started. And now I'm a big believer in it just because I've seen and I experienced, and I mean, I've made almost all the mistakes. Like if you read my books, the reason I know what I'm talking about is because like I made all the mistakes and learned from them. Hopefully, I learned from some of them, and I'm still learning from others. But what it really comes down to, like if you want to distill everything into one simple package, is that in order to succeed as a trader, and I would say as an investor too, although I think as an investor, it's like psychology is less important, simply because it's easier all you have to do is basically not sell the lows in a panic and not buy the highs in a panic. And the positive drift of equities and assets have yield. And so there's a positive drift to being an investor. You're going to make money if you just sit there and do nothing. Whereas as a trader, I think the psychology aspects are much more important, but really it comes down to being rational. So like no matter whatever you say you have the best ideas and you understand everything about the markets and you know how everyone's positioned. If you then come to say like, okay, that makes me want to be long dollar yen, and then you can't pull the trigger, or you see some headline and then you were long, but then you go short because you saw the headline, or you have emotional attachments to like, I'm finding it really hard to be long dollar yen because I made so much money being short. I mean, there's like hundreds of different types of bias that can go into it. But essentially, I think it's harder to stick to whatever your rules are than it is to actually know what the correct rules of trading are in terms of like how to get trade ideas, how to manage your risk. I think the biggest leak is that people just don't do what they know they should be doing. So like, People know, like generally people don't want to be overweight and they don't want to be unhealthy, but yet, a lot of people eat Pringles and eat chips and like sit around and watch Netflix, and they know they shouldn't be doing that. Right. So like, it's sort of the same with trading. Like, you shouldn't keep moving your stop. You shouldn't trade when you're angry. You shouldn't stop out because you're nervous. If you have to have a certain amount of courage to trade well and things like that. So yeah, the basics are like a functioning risk management system and a good understanding of variance and like how to size positions and all that. Like, you need all of those things. Those are like the necessary but not sufficient conditions. And without good psychology and discipline, like discipline's a big part of it, then it really doesn't matter. Any of the other stuff doesn't matter, because you're just going to end up pushing buttons when you shouldn't be pushing buttons, and getting out at the wrong times and all that. So yeah, I think that psychology is almost like above everything. Like, you can kind of lump in risk management with psychology, but I think those two aspects are the most important in the long run, are the most important inputs into whether someone's going to be successful. Is like, are you conscientious and rational and following whatever system, and especially on the risk management side. And I think one issue is that the fun part of trading is like solving the puzzle and coming up with ideas and all that. And the boring part is like optimal risk sizing and creating spreadsheets and then sticking to them and not getting sucked into like trading 5 times your correct size because you're so excited about the headline or whatever. So most books tend to be about trade ideas and how to trade kind of thing. Whereas like there's not that many books about risk management, and there's quite a few psychology books. But the problem with trading psychology in general, and this is kind of true with any type of any type of bias, is that like, okay, first you need to learn about it, which isn't that hard. But then even people who know about all the biases, like if you read Kahneman and Tversky, they go through all the behavioral biases that impact investing and all that. But the thing is, even if you know about it, you still have the bias. So it's very difficult to override. And then it comes down more to being like very self-aware. So I think one big thing big jump that I made in my trading was, and this sounds a bit self-helpy again, but when I could kind of go outside of myself and see myself making mistakes. So, selling, like I'd be doing something. Sometimes I've even said to like a guy sitting next to me, like, I'm bullish, but I'm short right now. And I know this is stupid. Like I will say those words out loud. And that's good self-awareness when you can do that, right? Instead of when I was 25, I'd be like, really my thesis was bullish, but I got short somehow through some headline or something. And I'd sit there and figure out a way to justify the short position when I was 25. And I would convince myself that I was bearish, even though I had just been bullish like 2 seconds earlier. So I think getting to the level of self-awareness where you can see yourself making mistakes is almost like, for me, that's like the best I can hope for. Is not like, I'm never going to like stop making all the mistakes, but a lot of times now I see myself making them and then I can course correct. Because a lot of it is a battle between, especially in short-term trading where you need to react quickly, is the battle between like system one, fast thinking, like heuristics and like quick reaction, and then system two, which is more thoughtful and logical and all that. And so if you're always using system one and just reacting to everything, you end up gambling and playing like a video game, trading for fun. But if you don't use any system one, you're just sitting there all day waiting for the perfect trade and you never actually do anything. So what I tend to do is more like let my lizard brain stuff go. And I like, if I kind of have a feeling something's breaking out and there's news and I think it's big news, then I'll do the trade, but then do a logic check once I'm in the trade with where I kind of chill out and write some pros and cons and say, okay, like, does this actually make sense? So those are the 2 steps, but then you still have to be able to, like, you bought them at 40, now it's 37, 38, and you're like, this is a stupid trade. People tend to anchor on wherever they got in. So then instead of saying this is a stupid trade, I'm going to sell at 37, they say, when it gets back to 40, I'll sell. And then when it gets to 40, they're like, maybe I can make 1 pip profit. I'll sell it at 41. So that's the kind of like irrational stuff that goes on where people value positions that they have on, even if it makes no sense to stay with the position, as an example. Oh, I can't hear you right now. I can't hear you.
Yeah, no, I accidentally pressed mute. I'll go from.
Oh, that would explain it.
Yeah, it's really interesting actually. When I started trading, which would have been about 10 years ago, I started trading futures, which is kind of a baptism of fire when I was trading the S&P and oil and the DAX actually for a little bit too. You find out, like you were saying, sort of that self-awareness side, you find out so much about yourself. And I found out very quickly that I was awful at trading fast-paced markets. So now I'm more of a swing trader, very systematic approach, and that's what suits me. But if someone said, look, Sam, you're going to have to go trade non-farm payrolls or the Fed meeting, I could guarantee I'd lose money. But, when it comes to...
See, that's a really good point, I think. Sorry, can I interrupt for one second?
Yes,
I think that's a good point for the viewers to take in, is that when you're new, if you work at a bank or a fund, you tend to like listen to what the people are doing, and then you kind of want to emulate that. Or if you're reading books, you kind of like think, oh, this person's an expert. I'll do that. But what you should really be doing is starting with the baseline of like, who am I and what's my personality? And then taking bits and pieces from people that you learn from and incorporating them, instead of trying to do what someone else is doing, like you're saying, because you'll never succeed doing that. If you're a very slow kind of like personality, slow energy, very thoughtful, intellectual, you shouldn't be day trading, non-farm payrolls, like you said. So I think understanding like how to incorporate and learn, but still also develop your own style at the same time is the path to success. Whereas I find a lot of people by default tend to emulate or like try to replicate. And I don't think that's not a successful strategy, especially because really good traders adapt and change their style over time to recognize regime change in the market. So even if you're emulating like the best trader in the world, that person 6 months from now might be trading mean reversion because even though they were trading trend when you started copying them, they've realized that like, okay, economic volatility is collapsing, I'm going to start trading mean reversion or whatever. So it's much better to develop your own style while like respecting people who are good and taking bits and pieces, but never trying to emulate them.
Yeah, no, completely agree. Quick one. What's more important, learning to win or learning to lose as a trader?
Yeah, that's such a random question because I think it's actually the for me anyways, I think that, again, this is probably personality based, but for me, it's more learning how to win, because I felt like throughout my whole career, when I'm down, I always trade well. So for me, like the essence of my trading style is tight aggressive, which again is like a poker thing, but it basically means when you have a good hand, you just be really aggressive and have the courage to bet big. And when you have bad hands, fold. And when I'm trading well, that's what I'm doing. I'm just sitting here flat all the time. And then something really good comes along and I do it. And a day and a half later, I'm out. And then I'm sitting there waiting for the next thing. And when I'm trading badly, it's like playing 3-7 offsuit. You're just like, oh, there's a chart break, I'll buy some euros. And then, as soon as it goes down, you don't believe in the trade because it was a lame hypothesis. So then as soon as it goes down, you sell, and then it goes back up and you're like, oh, it's back above the trend line. So like that kind of thing is bad trading for me. So for me, when I'm down, I trade tighter and I trade better. And then because I have like a bit of a gambling, I like gambling and I like stimulation and all that kind of stuff. Like that's my bias. So my bias is to overtrade. So then when I'm up a lot, that usually my blowups have come from like a very high watt, usually from high water is when I have a really bad run. Because like say you work at a bank and your budget was $10 million and you're up 17 million, and then you're feeling overconfident and you kind of have some money to burn. Like that's the house money effect in casinos, where people who have a lot of black chips in their pocket gamble really stupid. And people who have like barely any chips gamble a lot tighter. And there's a lot of experimental evidence that shows that. So I actually have conditional formatting in my P&L spreadsheet where like I know kind of like what a good run rate is. And then if I'm way above that, it's my spreadsheet starts turning pink and then red. And so I reduce risk as I'm over, only when I'm like, it's kind of a continuum. So like if I'm doing well, I take more risk because I feel like that's how you can get really exponential upside, is like once you have gains, you're strong and you have kind of like, you're in the strongest trading position. But then there's a point where that hits diminishing and then negative returns where you're overconfident and you're just like making it rain in the club because you got so much P&L. And then you usually give back a big chunk and then you're like, oh, I wish I hadn't done that. And then you go back to tight aggressive and trade well again. And I mean, even my boss one time said to me, I had a huge loss one time at a bank. And he's like, the only time you ever learn is when you lose. You know, when you win, you think you're a god of trading and you've done everything correctly. Whereas, you know, there's a lot of variance, right? So if you're making money half of the days, like 50% of days, and your win ratio is 2-to-1, like you make twice as much on the up days as you lose on the down days, that's going to be you're going to be an amazing trader, right? But you still might lose money 5 days in a row or make money 5 days in a row, simply because if you flip a coin 5 times, it could come up heads 5 times. So I think generally when you're doing well, human nature is you ascribe the causality to your like godlike trading skills. And when you're doing poorly, then you tend to be more introspective and self-aware. I mean, at least for me, that's the way it is.
Thank you very, very much for coming on. I'm sure our audience will have found it incredibly interesting, as I did as well. So thank you very much.